Hello, Winning Investor Nation. Welcome to Monday Market Insights with Ian and Amber. Actually, we're recording this this webinar on Friday, October 7th. So we just want to thank you for joining us. Good morning, Ian. How are you today?
I'm doing well. Good morning. Happy Friday.
Yeah.
Happy Friday to Alex, who seems to be his usual chill self behind you right now.
He's literally snoring right now, but yes, he's chilling.
It's not picking up on the microphone, though, I can tell you that.
No, it's little dog snores, so he's good.
Wow.
Yes, Ian. Happy Jobs Friday to you. Uh,
Mhm.
and as we say here at Winning Investor Daily, everyone, bad news in the U.S. economy is actually good news for our stocks, as it means that the Fed may soon pivot. That's the word pivot, from raising rates. But based on the numbers that just came out this morning at 8:30 a.m., the latest September jobs numbers, well, we're not seeing that bad news just yet. U.S. hiring actually continued at a solid pace in September, and the unemployment rate fell. Payrolls rose by 263,000, mostly in line with expectations. But the real eye openers were the drop in the unemployment rate to 3.5% from 3.7% the prior month. And the labor participation rate, Ian, it actually ebbed back to 62.3%. And many of the added jobs came from the leisure industry, the hospitality industry, as well as the healthcare markets. And the U.S. labor market actually showed strength, and it shows strength in helping to potentially boost consumer spending while advancing wage growth, which is one of the key factors in what the Fed decides to do going forward. So we're going to probably see continued wage growth as employers really compete for a limited pool of available workers right now. So, for now, the labor market remains tight. It's proving resilient to the Fed's interest rate hikes. Indices actually they turned negative on the news. And this should just underscore, Ian, a 75 basis point consensus for the Fed when the November meeting commences. So how do you see this playing out on your end?
Yeah, I think the odds are already about 85% for a 75 basis point hike at the November 1-2 meeting. It happens a 2-day meeting.
Right.
And then they went to about 95%. So, if there was any slight chance that we'd be getting a 50 basis point hike, that's totally off the table right now. I think that if there was any ray of sunshine in the numbers, it looks like the rate of wage increases is slowing down. So it used to be an annualized rate of about 5% in wage increases, and now you're seeing somewhere around 3.5%. So that should help out inflation a little bit. But, the bigger picture here is obviously that good news for the economy is bad news for the stock market right now, because it means the Fed is going to have to deliver a stronger dose of medicine in the form of rate hikes. Right. And we're seeing it across all interest rates today. You've got the US 2-year note back up at 4.3%. And I think that is the most consequential indicator for stocks, because as an asset allocator, as a fund manager, if you're looking at stocks, S&P 500 stocks, where the dividend yield might be a little bit under 3% versus a risk-free rate on the 2-year of 4.3%, I mean, this is a very juicy investment right here. And it's just acting as sort of a Death Star, this 2-year note, just sucking in capital from other markets. And so, I think that is something that we need to start to see the yield reverse at some point to hit some type of inflection point before we see solid flows back into the stock market. Now, I would say one thing, though, is that it should not come as a surprise that the jobs number is stronger than expected. Throughout this quote unquote recession or slowdown period that we've seen, the jobs number has consistently beat expectations. It really is. But if you look at where the weakness in the market's coming from, it's coming from the housing market, which is showing slower sales growth. It's coming from manufacturing, where you have PMIs that are dropping down to almost recessionary levels. Whereas since, the job market seems to be pretty sticky and employers continue to hire, anecdotally, though, Amber, we've seen in the last couple of weeks, whether it be Facebook or Peloton just yesterday, saying that they're going to start laying off employees. So maybe it just hasn't filtered into the data yet.
Yeah, it's a wait and see situation. But yeah, those numbers are truly coming in right now. We'll see how it plays out. So, Ian, I have a question for you. So,
Mhm.
where the current Fed situation is concerned and their potential future activity, what are we doing on our end for our subscribers to navigate through this Fed market that we're dealing with right now?
Yeah, great question. And, it's really been the reality since 2008. The Fed is the only game in town.
Mhm.
And, if you look at what's on the horizon for our central bank and central banks around the world,
Mhm.
the amount of control that they have over the economy, and over society in general has not only dramatically increased since 2008, but I think it's poised to actually increase even more this decade.
Mhm.
And, the reason I say that is basically there was no such thing as quantitative easing before 2008. It was something that I mean, Japan had done it, but there was none in the United States. Bernanke essentially, made it up here, where the Fed would go into the open market and they would buy long-term securities so that they would bring the yields down on bond markets and allow credit to flow more freely through society. We're starting to see the inverse of this right now, where it's like the Fed's raising rates and they're trying to do quantitative tightening, and you're seeing the impact on markets. Now, the Fed and the government are creating basically a new product and project, essentially, called a central bank digital currency. And I don't want to sound too much of an alarmist right now, but it is a way for the central bank to create a digital currency to replace cash. And, you might say, okay, this is great. Now we never have to carry cash around. But, there's going to be some downsides to this. And I think I need to make sure that viewers are really aware of this. Number one, what the Fed is trying to do is break what's called the zero lower bound. Okay. And that basically means that, they have limited tools in their toolbox. They can cut rates to zero and they can do quantitative easing. When they cut rates to zero, it gets to the zero lower bound. They can't impose negative interest rates because the impact would be if they impose a negative 5% savings rate on your Citibank or Bank of America account, you would probably go to the bank and take the cash out and then, go bury it in your backyard or something like that. Or just everybody would massively withdraw cash from the banking system. And we all know that we live in a fractional reserve banking system, whereas the banks don't have all the reserves to pay everyone back if everybody suddenly wanted to get their money out. So what they can do with the central bank digital currency is, number one, break the zero lower bound. They will be able to put some type of penalty on your savings. So you will not be allowed to take your money out of a bank because there's no cash for you to withdraw.
Mhm.
And they could also put an expiration date on your money. So let's say you've got a savings account, they could say, okay, if you've got $10,000 in the savings account, and I'm just making spitballing here, but you have 10 years because we're going to impose, let's say, we're going to degrade your money by 10% every year. And what they want you to do is spend and go consume or go invest or do something else than saving it to try to stimulate the economy. The other negative impact is that when you give the government more control over overseeing transactions, let's say you elect a Congress or a government that doesn't agree with half of the country, and they decide that they're going to penalize these people, or they're going to penalize certain types of behavior. And, we've seen a little bit of that happening with the soda tax in New York City, where Bloomberg imposed extra taxes if you wanted to go buy a big gulp at 7-Eleven. But we haven't been able to do the widespread part where it's like, if you want to drive a gas guzzler, we're immediately going to put like $1 extra tax on every gallon. And these are some of the things that they could be doing with a central bank digital currency. Now, I know I'm sounding like an alarmist here, but I have put together a special report. I'm very excited about this, talking about the things that you can be doing now to protect against a central bank digital currency. There are three specific things in mind. We are releasing a webinar for all of you who have already subscribed to my Strategic Fortune service. You'll be getting it for free. It's a bonus report. And for those of you who haven't yet, check out the webinar where I explain more exactly what's happening with this project, with the Central Bank Digital Currency Project, and how to protect your wealth against what could potentially be coming in the next couple of years. So please check that out. And that I think that is a bigger risk to society and the markets in general than just what we're seeing with the Fed right now raising rates.
Wow, Ian, I am just blown away. I think that's a timely report. I'm glad you're offering it to your subscribers. So thank you, Ian, for sharing.
Awesome. Thanks, Amber.
You're welcome. So Ian, well, just to continue with the economic outlook for this week, we have about 5 major economic releases to look forward to for the week of October 10th, I should say. So on Wednesday at 8:30 a.m. Eastern time, we have PPI final demand month over month for September. We're expecting the forecast to show an improvement of sorts. And on Thursday, of course, the much anticipated September CPI month over month and year over year will post at 8:30 a.m. Eastern time. And for those two numbers, just so we can get a forecast, I'm checking Bloomberg right now. For the month over month number, we're looking at a 0.2% from surveys versus 0.1% from the prior month reading. And for year over year, 8.1% as the reading versus 8.3% from August. So Ian, how do you feel about that 8.1%? We're still above the 8 handle there. So do you see?
Yeah, CPI is still the biggest indicator of the month. I mean, it always, historically it's been the jobs report like we saw this morning, but I think even more so it's now the CPI, because that is what the Fed is essentially trying to fight by raising rates in the fastest pace in history, right?
So true.
Yeah, and we said last month, if you see a print above 8% or above expectations, you're going to see the market sell off. That's what happened. I think that I'm trying to be a little optimistic here, but we could potentially see something below 8% for the first time since I think June was the last time. We had that July reading, I believe, was 9%, and then August, September. Yeah, so we could see a 7 handle. Is that going to cause a 10% stock market rally? I mean, a lot of people are kind of positioned for no Fed pivot, especially after the jobs number today. So we could see a pretty significant short squeeze just to keep some of these bears honest. And the other thing I'll mention too is that one thing in the CPI data that's been overlooked that I've been reading about is the way that they calculate healthcare costs. And you could see the computation of healthcare costs coming down this month because of what happened a year ago, where when COVID essentially ended, people who were waiting on non-elective surgeries went out and got them when they felt the hospitals were safe. Okay. And so you actually saw the way that they compute healthcare costs is by premiums versus claims paid. You had very high, you had no claims paid when people weren't going and getting surgeries that they didn't need during COVID. And then you had a whole wave of them that happened late last year in 2021. And now, that's obviously tapered off. So you're not getting that big impact in the year over year change. So you could see that the healthcare number come down, and that could be a way that we get CPI below 8%, because, right now with the labor market, it's not giving us any help. With the labor market being stronger than economists expect.
That's a good point. Well, let's see how it pans out. We'll find out more next week, much anticipated. And actually rounding out next week on Friday, September's retail sales and October's University of Michigan sentiment will post at 8:30 a.m. and 10 a.m. respectively. And for retail sales, Ian, we're looking at 0.2% for the month of September versus 0.3% in August. And for the sentiment number, which is all about consumer sentiment, we're seeing a slight tick up there. So still possibly good.
Remember, the beatings will continue until morale improves.
I know, right? That's your say.
I mean, it's like, if you get a phone call and anyone asks you how you feel about the economy, say something negative. Although, consumer sentiment probably ticked up because gas prices had that downward trend for 60 or 90 days throughout the summer.
Yeah, I think it.
Right, but we need to see weaker data on the sentiment side, especially. We need inflation and sentiment down in order, if we're looking for a Fed pivot. But we had a lot of Fed speakers come this week, and all of them said, they're all sticking to their guns. It's like,
Yeah.
we are going to keep raising rates until we see inflation materially come down. So, when they say that, we have to believe them. Doesn't mean the market is going to continue to sell off. And I do think that we're going to be sort of bouncing along the lows in a range until we start to see some better economic data. But I also believe that there's just too many people leaning into that side of the trade where it's like, believing we're going to another financial crisis, another Armageddon right now, which makes me a little worry of it, meaning that, there's probably better risk to the upside than there is downside, because you've got so many people that are making these big macro calls that the end of the world is coming. And we've heard this time and time again, and it's a once in a century event like 2008. I don't think we're going to see that again.
It's true. That's a very good point, Ian. Okay, well, we're going to switch gears a little bit away from the economy and look at our megatrend happenings. And I'm sure many would have seen this by the time we post this video on Monday. But in Tesla news, Tesla plans to finally deliver its semis, its Tesla Semi, to Pepsi after a 5-year wait. Pepsi, we actually reserved 100 Tesla semis, and they aim to deploy the first 15 by the end of this year. According to Bloomberg, a semi is expected to be eligible for up to $40,000 US incentives. So once it hits the market, you may see more Teslas on the road, not just from Pepsi, but from other people purchasing Tesla semis. So I'm looking forward to seeing one in person myself.
I'm looking forward to see them. I'm not looking forward to getting passed by a self-driving semi anytime soon, to be honest.
You're not, I know.
Like, I'm fine with it being electric, but make sure there's a driver sitting in the cab. Although, with the autonomous vehicle revolution, the easiest problem to solve is semi trucks driving on highways.
Yeah.
Because there's a lot less decisions that the car has to make when it's basically just going in a straight line and, following the lanes. So, you probably start to see self-driving semis with no driver before, you start to see the Ubers that are driving around your neighborhood. Although, some cities are already seeing that, San Francisco and Austin especially.
Of course.
But Amber, do you think that there's anything to Tesla revealing the semi delivery, with also Elon being in the news with Twitter this week? Obviously, that it looks like he's going to be forced to acquire Twitter at $54.20 a share, which was his original offer that he tried to back out of. I can't say I blame him, because the stock's probably worth 60% less than that right now. So maybe he's trying to put some good news out there for Tesla, which, I don't think Tesla investors are unhappy with hearing more, good news about the stock, even though Elon's trying to save a little bit of face right now in the public view.
I'd say we'll take the good news. We love good news for our Tesla stock holdings. So, hey, we'll take it. So, it benefits. The thing you also have to understand about Tesla is that they don't spend any money on marketing. No, so whereas like GM and Ford are spending billions of dollars, Elon just tweets, and and people go buy the cars. So I know.
Keep tweeting.
Keep tweeting. That's right. There's your advertising right there. So Ian, I think that's it for this week. Do you have anything else you'd like to add before we sign off?
No, I think we covered a lot. Obviously there's a lot of economic news out today with the jobs numbers. We got the CPI next week, which is what we're really focused on. Right. Markets obviously are down today. They rallied for most of the week. They gave a lot of that back today. This is just indicative of a bear market where, we're going to churn. So if you're an investor and you're looking to purchase more or get out of some stocks, don't chase on those days when the market's up 2 or 3%. Like, you don't want to buy then. Like, the bear markets will give you opportunities to get in and get out if you need to. But the last thing you want to do is buy after the market's rallied 5 or 10%, and then the next couple of days it's down 5 or 10%. So, and also keep the position size small. This is the market. This is the time period that is very easy to get chopped up. And so, at the old trading firm, we used to say, bear markets don't scare you out, they wear you out, because if you're trying to grind out profits in markets like this, you have days when it goes up and then it gives a battle back in the next couple of days, and there really is no underlying trend either up or down. So just be careful out there.
Oh, that's sage words. Thank you, Ian, for sharing that with everyone. And well, with that, thank you everyone for watching. We appreciate you very, very much. And know that you can follow Ian and me on Twitter. Ian is at Invest with Ian. I am at A Lancaster Guru. And please remember to give us a thumbs up if you do find these the content of these weekly videos helpful, as it does help support the channel. And of course, click the subscribe button and the notification bell to know when videos are posted.
And what we want this week is, if any comments you have about CBDCs, are you worried about them? Central bank digital currencies, have you heard of them? What are you hearing? Please comment below. Any questions too, we can also address in future webinars. We'd be happy to get to that.
Oh, definitely. Concur. Okay, everyone. Well, thank you again for watching, and we wish you a good week ahead. Until next time, take care.
Thanks, Amber.
You're welcome, Ian. Bye.